And welcome to another edition of the Nerdy Agent Podcast. This is Josh today, hosting on behalf of our brother Luke, who is celebrating his 30th birthday today. 30 years. Happy birthday to Luke. He's going to be taking the day off of work, hopefully. We've already got a couple text messages from him, but we try to make sure that he can enjoy his birthday and spend it with his family and get to do the things that he loves to do because he deserves that.
Yeah.
But we are going to keep moving forward here. We're going to talk about the most recent bill that has been passed surrounding the tax landscape. Some have touted it as the big, beautiful bill. It's probably been something you've heard a lot about in the news. We're trying to break it down in a way where we can give you some interesting nuggets as to how it will impact taxes in the real estate space, how that might change some behaviors, and ultimately how it might be important for you and your clients, and so that you can break it down for them in a way that you can, kind of talk to them about it. So, AJ, do you want to just kick off? We have a couple different things here that we're going to touch on, but yeah, which one do you want to kind of start with today?
I think we should start with like individual consumers and their own taxes. So obviously this is a tax bill. So for those that don't know, you have two options on your individual tax return. You can either file with the standard deduction, which the previous bill in 2017 increased quite a bit to try to cut down on the number of people who use the second option, which is itemizing your taxes, itemizing your deduction specifically. And what that does is, so his bill raised the standard of this, and this newest one raised the standard deduction for single filers to $15,750, for head of household to $23,625, and for joint filers to $31,500. This used to be, I want to say, like when I first got into real estate, was filing my taxes, it was like $11,000. It was
a lot lower than that.
So we always itemized before because, you can take your donations, your interest deductions on your home. Back then it was free season for taking property taxes. And apparently for insurance, which I couldn't remember that, but that actually phased out in 2021. So the first thing that got thrown back in here is that mortgage insurance has been restored as an itemized deduction. So for those filers who do have lots of donations or a big mortgage payment with lots of interest, they will likely be kicking themselves over that 31,500 number potentially. They can now take itemized deductions and include their insurance, which is an interesting one. I think insurance has been kind of a hot button topic lately. It's been going, I got a text this week from a guy, told me his insurance has gone from $125 a month on his new construction home in 2017, 2018 to like $350 a month now. So he's shopping around for new rates and such. So that one's a nice one to throw back in there, kind of to.
It's kind of interesting in a home that new that they have that big of a jump in insurance, because the roof is still new, and that's where most of the costs historically have been.
It's a shared cost, like when you're in a country, in a state where there's lots of claims and lots of money being thrown around, these insurance companies are getting smoked. So
we can maybe talk about insurance in more detail at some point. Yeah, we can surely. It definitely has changed in the last 5 years in terms of, what are they going to cover a roof to? Now it's like, it's going to change a lot when you have an older roof on the house that you're looking at.
Exactly. So I think, for those people, and again, if you understand how, the standard deduction filing versus itemized happens, for those that are itemizing, that is a helpful thing to get tossed back in there. The other one that I believe the Democrats fought for, because this was really in the first tax bill in 2017 aimed at these super high property tax states, which are historically blue states. So the Republicans were kind of going after the Democrats. That was kind of the word back then. I believe the Democrats got this thrown back in, and even some Republicans in higher property tax states, I read some articles about them being in favor of this, which was it increased the SALT deduction. So for those that don't know the acronym SALT, it stands for state and local taxes. So call that state income tax and property tax are like the two main ones. So if you live, here locally on Lake Minnetonka, you were only allowed to take 10,000 of your property taxes and your state income taxes as a write-off. But now that is increased to 40,000. I believe there are some phase outs for high income earners. So that one's going to be interesting to see because, I think it was like over $500,000. It starts to really phase out quickly in income. Typically, the people that are paying $25,000 a year in property taxes probably are making more than $500,000. So it's going to be interesting to see how much that actually gets used.
Right.
But that one, again, these are all aimed at targeting different sectors of our economy. And specifically, we're obviously talking about real estate because that's what we talked about on this podcast.
The interesting thing on the standard deduction is the first bill that was passed in 2018 is the one that actually first jumped to that. So in 2017, that was 12,700 for married filing jointly. And the first bill pushed that up to 24,000. So when they initially did this, that was kind of the goal, was to push that number up. And then it's kind of creeping up from there, 24, 25, 26, 27, no. Went from 29 to over 30 now. So it is has kind of become the new standard in quotes, but to have that be at a higher level.
And what's interesting there is when you push both the itemizable deductions and the standard deduction up, you kind of wonder how many people are going to fall into the itemized deduction bucket. I thought increasing the standard deduction, while it definitely reduces tax revenue for the country, I think they potentially thought that maybe it would not, because it would cut down on the number of people that are actually itemizing, and maybe itemizing things that were a little more gray potentially. And that actually reduced a lot of the expense of probably the IRS, because they're probably having to scour through a lot more things if they're looking at a bunch of itemized deduction tax returns. When people just take the standard deduction, it's pretty easy to go, oh yeah, they just took the 31,500 or whatever they were allowed to do.
Yeah, simplifying things theoretically is a good thing. Through some of this, what specifically after that do you want to catch up on? We talked about like some of the low income stuff that got added to the bill and how that could potentially impact some clients. Did you want to connect on that?
Yeah. So another good one that I think, again, there's things that are going both directions, and I think you see this because you've got left-leaning people involved in the decision making, just because the margins are so tight. I don't know what it's at right now in the House and the Senate, but it's like pretty tight.
It's very close.
And so to get not only the moderate Republicans, but also the further left Democrats to agree on something, you have to have some policies in there that actually benefit everybody. And so they threw in this tax credit for builders and developers who build or convert rental housing into low to medium income housing. So I imagine that's based off of median income for the area. And they say if it's at the median or lower, and maybe there's some better benefits. I didn't dig into exactly all the things that were in there. Better benefits if it's actually like half the median income.
Yep.
And it starts to probably get better and better as the type of tenant that's getting in there from the income perspective gets lower. But that's to try to spur more building and growth for the people that really need housing badly right now. And, we probably talked about it in the podcast before, but the affordability of purchasing, as all of us know, has gotten significantly worse over the past few years. But at the same time, the rental market has gotten worse. So to help these people who desperately need help getting housing and having places to go is, I would say probably a good thing. I mean, they say their estimate is that they will increase the amount of affordable units by around 1 million units in the next 10 years. So call it 100,000 a year. It's a lot of people that should get housing that maybe were denied or unable to find adequate housing in the past.
Right. And they've also made an effort within this process to be focused in on rural zones too. So they added, where's the verbiage exactly, but is essentially a rural opportunity zone to try to increase and spur investment there. And a certain percentage of the investment has to happen within rural communities. And so I think there's a push not only to, to your point, build density in lower income housing options, but also to expand out into other zones that maybe hadn't been having as much building happening with them in the past.
Yeah, I think that, the opportunity zones thing is an interesting one. Again, it's all why I love this stuff, whether people agree or disagree with it. And there's probably a lot of parts of it that I would be like, yeah, I don't like that, but I like this part. Is the economics of all of it seem to be fairly well thought out, because you have so many smart voices involved in making the decisions. That you go, okay, well, how about we try to increase the amount of rural activity that's going on? There's not a lot going on right now. what can we do to make it so these communities continue to thrive in a world that's becoming more and more urban? We talked about it all the time. We just hired a new employee from Tennessee, and I told her about my experience driving through like the foothills of the Smoky Mountains. And I was like, man, I like people always yell like, man, Costco, Walmart, all these places, they took away all the jobs, they wrecked everything. And I was like, here locally, like you didn't really see that here. I mean, there was like,
Yeah.
you went to the U of M and it's like, yeah, sure, the little corner shop had to shut down. There's like so few little corner shops where this was the only place, they were in like a food desert. Right? And this was the only market where they could get milk and eggs and things like that. And then, Walmart pops up 30 minutes away, and it's like all in those places, like those rural areas, it just wiped out like full towns. And I drove through 6 different small towns where you had one restaurant, one gas station, and you had 12 other buildings that were vacant. And it's like, man, it really did devastate these areas.
Oh, yeah.
I didn't realize that because here in Minnesota, it's like, yeah, they put one up in Eden Prairie, and then people from Eden Prairie decided, do I want to shop at Cub Foods or I want to shop at Walmart? It wasn't.
I mean, on a smaller scale, my college town that I was in, they put a super Walmart up and the grocery store closed. It's wild.
And it's mostly these small rural areas. And so I think they're trying to spur some investment in that and bring life back to small town America, in a way that maybe hasn't been happening more recently with all the corporate moves that have been made by these larger companies.
Yep, absolutely. And we can keep going. I mean, there's a lot of stuff in here. We don't want to this is called the Nerdy Agent Podcast. So we definitely want to be somewhat nerdy. We don't go so nerdy that you don't feel like it's necessarily applicable. One other thing I want to call out, 1031 exchanges, which is something that we've talked about before. If you're not familiar with them, they're essentially, you can defer taxes on rental properties if you essentially do a like kind exchange by selling one rental property and shifting the proceeds into another rental property. You could avoid paying capital gains tax on that change. They were preserved with this bill too. So that's another one to call out specifically if you have investors. They're going to be probably familiar with 1031s, but that is a pretty significant benefit to real estate investors that exists out there today.
Yeah, and it's kind of one of those where you go, okay, you're probably benefiting, wealthy and ultra wealthy people with this 1031 exchange, but also you look on the flip side of it, and yes, through the lower income thing, it might get really interesting to see how that all plays out. Yeah, they are providing a benefit to the community by owning these properties for people that need rentals to live in. Specifically, like Jim Rubin, Mint Properties is a real estate investing mentor. Like he has Class B properties. It's not like, he's not renting out a 2-bedroom for $2,500 a month. It's like it's $1,200, $1,400, $1,600. And these are blue collar workers that need a place to be. And these 1031 exchanges, he has told us, have helped him really expand the amount of properties he's able to own and service. So while some people on one side of the coin might say, well, it's just benefiting these wealthy people, it's like, well, the flip side of that is he's able to continue growing. And if he's running a good company and he's treating the tenants very well, obviously that doesn't always happen, but someone like him is doing a really good job providing a great service. It allows him to continue to expand and serve more people with his rental properties. I think the interesting one that we talked about before we started was most recently, this was not in the bill, but Trump wanted to get rid of any capital gains on the sale of a primary residence. And we talked about this, and that one to me seems like a total, like, this just really only helps super wealthy people.
Right.
I don't know that I've ever had a client. I probably
Had any capital gains?
I don't know if I have. I mean, like maybe at one point I did. Someone that maybe lived somewhere for 30 years and sold a place for $800,000. They paid 80 for.
Yeah.
But we talked about it. Like most of those people paid 80, but then they did a $300,000 project at some point while they were living there. So they still don't have capital gains because of that.
Right.
We've talked about the idea that has been floated around. I've seen it on the internet. I think I saw someone that was actually in Congress throw this out there of eliminating capital gains tax on single family rental properties for a certain period of time would be a super interesting way to bring inventory back to the market.
At a minimal level. So you'd only do it on you could only do so many sales.
Yeah, so you wouldn't benefit the massive companies that run 40,000 single family homes. You'd let them do 3 a year or 5 a year. That would probably move the needle. And I think we've talked about like a lot of mom and pop shops own we have clients, 1, 2, 3 rental properties. Just them putting one onto the market would really increase the affordability for people and might see prices flatten just a little bit, decrease the competition, and get some of these first-time home buyers moving again.
Yep. Because as we've talked about before, if a rental property owner sells a property, you have net one supply, right? They're not buying and selling, they're just selling. So you're boosting the supply side without affecting the demand side.
Exactly. And that's like, I was talking with a buddy yesterday and he's like, yeah, I mean, he's showing me screenshots, these guys on Twitter, of like what needs to happen for affordability to get better. And it's like, he's showing this guy saying like, well, we would need, if rates were at 6, we would need prices to come down by 5%. If rates were at 5, we need prices to come down by 10%. Going down the line kind of thing. Or maybe it was the other way.
Other way around.
Yeah. He's like, prices up, if rates were 4, we would need prices to drop by 5%. And I said to him, I'm like, if prices go to 4,
If rates go to 4, yeah. There's no way prices will but out.
prices will go insane. I said, there'll be absolute calamity. I said, we'd have to hire so many people to service the number of buyers that we would actually have coming in the door.
Yep.
And so but I said I think there is a world, I've talked about it before, there is a world where rates get into some range that's lower than today and prices don't really go up much more than they're going up right.
If rates also went to forward, you'd have to hire 1 billion new lenders to do all the refinances that would have to happen.
Oh my gosh, could you imagine?
It would be insane.
It'd be
I mean, it's kind of like what happened in 2020, right? When rates dropped as fast as they did during the COVID time.
couldn't even get a hold of lenders. They're just working 80 hours a week.
We know we find it. Yeah, we know lenders that were like having internal panic attacks. Like it was nuts.
Insane. Yeah.
So we used to do like a script of the week on the podcast back in the day. Like if you wanted to take this into one script of the week where you're talking to a client and you say, hey, they're like, hey, tell me about this tax bill. Like what is going on with it? What does it mean for me, or what does it mean for real estate or the market, etc.? How would you respond to that?
I mean, I think if they're asking from a residential perspective, I don't think the impact's that great. There's not enough in there that really seems like it's going to, if you're buying or selling property right now, if you're in a very narrow band of income, I think this could benefit you from a tax perspective and put some dollars back in your pocket. But like I said, the standard deduction has gone up so high, along with these itemized potential deductions going up high. But then there's a phase out period. So it's like, it kind of looks like to me, like not a massive impact on buyers or sellers. Now, if you're a, low income, maybe a service worker making $40,000 a year, and you're seeing, hey, developers are getting massive tax credits to build more property for you to potentially live in, I'd say that's a pretty awesome benefit. I mean, there's going to be new construction homes for low to middle income earners. We've talked about the wealth gap so much, and I think those people are significantly benefiting from this. But I think I would probably take this into like a commercial real estate perspective and just say 1031 exchanges are preserved. We didn't talk about it today, but like cost segregation has been, the bonus depreciation is back to 100% again.
Yep.
Permanently. You may see this kind of stabilize the office world, kind of stabilize your warehouse, industrial, and a lot of those have done pretty well, but office specifically, with all the work from home, and it's been a pretty difficult marketplace. And I think this hopefully will help to make it so there are less, large office buildings going back to banks. I mean, we've seen stories like that already. So that's probably the route I would take with a client, is just say, hey, I think this is more geared towards this commercial real estate stuff. They're trying to make sure that stays stable.
Yep.
And someone made the comment the other day, it's like anything they're doing right now, they're trying to ensure that real estate stays okay if there is something that happens in our economy, because the last time it wasn't okay, it was really, really bad, and it was a really deep recession.
Yeah, it's an important piece of the economic puzzle. I think the other piece I would add is obviously, as they've looked at this governmentally, the spending component of this, the spending component versus the revenue component continues to be, there's a gap there, right? So we do continue to have pretty large deficits, and the expectation is the bill will continue to increase the deficit that we have in the market. And so theoretically, what I would tell people is if the tax bill is intended to minimize the revenue side, because they're saying whether it's the tariffs or something else, they're trying to get the revenue from a different route. Theoretically, less taxes to the government means more money in people's pockets, which when people have more money in their pockets, there may be more continued growth in pricing within the real estate space. Now, I'm connecting multiple dots there to get to that conclusion. It's going to be hard to determine exactly what that looks like. But like we saw during the COVID timeframe, when we had stimulus checks and we had other things kind of going out to people, when people have more money, they are tending to be more inclined to spending that money. And so if we do kind of end up shrinking the amount of revenue that the government is receiving and keeping it more with people, there may be some sort of impact to behaviors within the real estate space, whether it is on the investment side and taking advantage of some of the things that are in the bill, or whether it is just your personal residence, things like that. We were talking a little bit before too about some of like the, the different components of projects, and certain things are, considered to be improvements that are energy efficiency things. There's other components that, people might take advantage of from a tax standpoint that will encourage them to spend more money on real estate along the way. So that's just kind of my last takeaway there. Anything else you wanted to add? That's it. That's all we got today on the Nerdy Agent Podcast. Remember, every day, be better.